what are the different fundraising stages for a startup? Now, more or less, most startups have a similar kind of fundraising journey. Now, obviously there are exceptions, there are differences for each and every company, depending on the sector that you have, depending on the product. There would be some differences. For example, if it is a very deep tech kind of product, they have a slightly different kind of fundraising stages in terms of revenues, etc. Because building the product itself requires a few $1 million or maybe even a few $100 million like Krutrip. So there are exceptions to this case, but more or less I'm talking about businesses which are pretty much standard in terms of tech-enabled businesses where tech is not the major difference maker, it's not the big advantage, but it just simply helps in kind of streamlining process, right? For those kind of businesses, this criteria is pretty much set, and this can be considered as a broad guideline in terms of how the fundraising goes. So the first and foremost, the most important stage is you bootstrap the company, right? You put your own 10 to 25 lakh rupees which are saved in the past, and you use that to build that initial MVP to kind of get the basic product ready, get the basic system ready over there, so that you can use that money to kind of basic setup and kind of show that you can build the product yourself. It's very difficult to get outside investors at this point of time because they don't know the product, they cannot visualize it, they cannot imagine it. That's why it becomes extremely difficult to kind of get outside money at this stage, right? So that is why in the initial stage it's extremely important to bootstrap it to get the basic MVP right. The next stage is generally the friends and family, where you raise some form of capital from friends and family, which could raise from 25 lakhs to 1 cr, whatever the range would be. The focus at this stage is primarily to ensure that you can get your initial customers, your initial traction in place, so that once you have that traction, you can then go on to future stages of fundraising. Now there are some very early stage funds over here as well, which invest at a very early stage, like Antler is there, which invest directly at the founder level, but that's more of an exception than a norm, and they typically invest in founders which have over a decade plus of experience, who have deep industry expertise, and they're kind of building on that industry expertise to grow further, right? So if you have that kind of a background, then that's an exception, and you can adopt that. But more or less, this is a major friends and family round is an extremely important round to get your first traction going, so that you can prove that there's actually a demand for this kind of product in the market. So then comes the next stage, when you're looking for when you already accomplished at least say 1 cr of revenue over there already, 1 to 2 cr of revenue. That is when the actual seed stage investing comes. This seed stage check could be anywhere from 250k USD to 500k USD. The idea of this stage is typically to get the actual serious outside investors, because now you've shown that you have some traction, you have shown that people are willing to buy your product, there's some demand for the product, and ideally you generated that revenue within a year or so. Because if you take like 2 years or 3 years to generate a cr or so of revenue, 1 cr to 2 cr of revenue, then there's a huge problem that there's not enough demand for the product in the market. Ideally you want to reach that 1 to 2 cr of revenue stage within a period of 1 year, because then you'll kind of communicate this to the investors as well, right? That the product actually has demand and is being aggressively adopted. That is why most VCs, right from the seed stage, right, they do not prefer very old companies. They ideally want companies which are like 1 to 2 years old at most, because if it is any older than that, it means that it's taken a lot of time to get the market traction which is needed, and that means there's just not enough demand in the market for that. That's why that's a very important benchmark which I believe most founders forget, and they simply focus on the revenue rather than also the time taken to reach that revenue stage. So this is what the seed stage is generally about. Once the seed stage is done, then comes the pre-series A stage. The pre-series A stage is typically $1 million to $2 million check. At this stage, you are expected to have at least $500,000 to $1 million of revenues within your business, because this is serious money that you're talking about. These are serious investors now, and they want to see serious results that you've generated already. Without these kind of revenues in place, it's going to be very difficult to get that pre-series A investment which is required to kind of go to the next level. Obviously, if you're a SaaS business or another kind of complicated tech business, there are some exceptions to the rule, but more or less you're expected to have a decent sum of revenue at this stage before you can start reaching out to investors for raising your first $1 to $2 million. If you want to go one step further and you want to raise your proper series A, which is typically $5 to $10 million, right? At this stage, your annual revenue run rate has to be over $1 million, ideally close to $1 to $2 million, because that's where Now you've proven that there is a significant proof of concept already in place. Most people, I kind of notice, most founders, they don't exactly know what the proof of concept stage is, and they think having 1 to 2 CR of revenue is considered proof of concept. But in reality, it's ideally at least $1 to $2 million. That's called as a proper proof of concept, because now you've shown that there is enough demand in the market that you can make this kind of money, and that the investors who are coming in at this stage, that they can get significant exit, because at the end, the VCs, they care more about getting an exit for them, for their investors who invested in their fund, right? You need to show that there is a market which is big enough, and once you reach the $1 to $2 million ARR, that is when that stage is established. Subsequently, once you achieve the Series A, then the natural progression is you can either do a bridge round or a proper Series B round, which is typically between $15 to $20 million at a valuation of like $60 to $80 million valuation. At this stage, you need to have like a proper, you already established that your product is there, you're making $5 million in ARR, and you are constantly growing. This is the hockey stick growth, which is gloried in the startup lore, right? You are at that stage right now. You're making at least like $5 to $10 million of revenue. The investors are lining up, good quality VCs, top tier VCs across the world. They are invested in a company like this, and they'll be kind of fighting for you, essentially. That you have VCs fighting for getting a bite out of that, and then you get the choice of kind of choosing which VC. All that happens at this stage, because now you've already proven the proof of concept. Now the question is, how do you grow it further? How do you grow it faster? And the VCs who are coming at this stage, they typically tend to have extensive industry expertise. They have extensive industry connects, and they can help you get that reach which you want to kind of grow the business further. Essentially, the cycle remains the same. Series C is at $50 to around $50 million. Series D is $100 to $200 million. It's all a question of nomenclature going forward, but essentially you get the idea, right? More and more the revenue grows, more and more you stand a chance to raise funding. Now, one thing which has changed compared to the past, funding hysteria which happened in 2021, is that it's not just about growth at any cost anymore. You need to have a basic principles in place. You need to be at least gross profitable when you're selling your products, because if you're not gross profitable and you're burning money, it's going to be